Worldwide Markets and FXStreet. Thank you for attending another edition of Market Directions Interviews. Today we have with us, we're very pleased to have with us, Gonçalo Moreira, a chartered technical analyst and content manager for FXStreet. Mr. Moreira, welcome and thank you for being here.
Thanks, Joseph, for having me.
You know, one of the things that I've always found interesting about trading is the intersection between the trader and the market. It sounds a bit pretentious, but the hardest thing I think for a trader to do is to accommodate themselves to a very rigorous way of thinking, which is not natural. And one of the things which is interesting about that is how people come to find themselves or desire to be involved in the markets. I know my own history, but we're interested in what you did. How did you become involved in the markets, both as a technician and just as a trader and as someone who's interested in doing their livelihood in something which is a bit alien?
Well, being born in Europe, I was used as a kid to exchange rates and to changing money. We migrated early in my childhood to Germany, from Portugal to Germany. My father was already living in Spain, so already during childhood, I recognized that you could have different nominal values for something or prices for something, and in very different currencies. So at that time, I remember, I think it was 80 escudos, Portuguese escudos, or 1 Deutschmark and things like that. It was later when I was working in a commercial activity involved in exporting machinery from Europe to outside of Europe, where I got confronted with what we call currency risk. I had to receive a payment in dollar. I was expecting that payment to be in euro. It was like 2001. The euro already started to appreciate. It was at that time by 10 points or so. And I thought, well, I was expecting a nominal in euro, and I received it in dollar, 10% less than what I was expecting. And there it's where it all started. Later on, it was, I think, by 2008 when I started working for FXStreet. And meanwhile, I invested in some managed programs. Then it didn't went so well. Then I wanted to learn it for myself. Well, and as a self-taught trader, I came to FXStreet, started working here, and it was a couple of years later where I decided to go for some formal education in FX in technical analysis, just to have a standard. I saw that techniques and theories were used in a very loose manner, and since I was involved with content curation and the quality of maintaining the quality of the site, I thought perhaps I want to go for some standard in technical analysis, and that's why I went to the MTA.
You know, there's a difference. So it's interesting. When you started, when you were a child, I was probably already sitting on the trading desk managing that particular currency risk that you're talking about. I've certainly found that currency trading is much more amenable to Europeans. Do you find that Europeans in general have more appreciation and also perhaps more integration with the idea of treating currencies as something of a financial instrument? This is certainly not common here in the United States.
Yeah, that's a good question. I think the main difference is the way how Europeans perhaps perceive value and price relative to a currency pair. You see in other parts of the world, I think an exchange rate is oftentimes considered as a stock price. It's something. It's a price of something, of an asset, and because we were used to exchange money, we perceive that it's a relative value, a relative price that you are just translating. Is a kind of translation, is one language to the other, and perhaps treating FX or an FX instrument as a ratio, as a relative strength study in the end, has some advantages, because in the end, if you move one part of the gear, everything else moves. I mean, nothing moves in isolation. If the dollar gets some flows in, that will impact everything else in a proportional manner, and that is perhaps something that Europeans may have as an advantage when it comes to risk management.
I think it's true. You know, the idea of foreign exchange as a portfolio asset, or even within the foreign exchange world, is an idea I want to return to in a little bit. When you instruct, when you teach, when you bring your program and your knowledge and expertise to traders, what do you find is the most valuable thing that you can convey to people? Or to put it in other words, put it in the reverse terms, what do you find is most lacking in most traders and when they start, and even well into their experience, and that's most important?
Mm-hmm. I think what most lacks, and this is, we are talking here on a very conceptual level, but it's flexibility and creativity. I see many people approaching the trading world in a very systematic manner. Already the term trading system already invokes something that has to be mechanical, has to be always equal, stable, and we are not wired in that manner, and this causes a lot of frustration, a lot of rigid behavior, where markets constantly fool the majority. I mean, we are seeing it now with the dollar. Is just it caught us most of retailers on the wrong side in the recent weeks. So this kind of rational approach and systematic approach to trading in general, not only FX, I think can be detrimental, and it will probably be much more detrimental in the years ahead, where flexibility is really demanded, and thinking out of the box. The problem is this is I mean, thinking differently, or constantly questioning your bias, and also the bias of the aggregate is very demanding in terms of time, in terms of energy, in terms of mental and emotional fitness. And we are seeing this in I mean, the appreciation of stock indices since the 2009. I mean, it's the most hated rally in history, and the more people call for a crash, the more it goes up. We are in a similar situation, although on a micro level in the dollar right now. So it really demands a very different kind of thinking.
I mean, it's an interesting split, because whether it's an automated system or it's your own individual system, people like to have an organized way of thinking about the market. The problem is, any organized system is based on an assumption, or a series of assumptions. The market, being psychological, is changing its assumptions all the time. So how do you integrate the idea of a system which is a generalized analytical basis, has a generalized analytical basis, and, as you say, the absolute need to be flexible? This is one of the reasons why trading systems have a limited lifespan, because the assumptions change. How do you integrate the two when you're talking to people about putting stops, about doing the actual work of trying to make money in a currency market?
Mm-hmm. I would suggest to switch from alpha seeking to preservation of capital initially. Just to preserve capital, you already are ahead of others, because you'll probably gain experience through time. Time in this case can be of your advantage if you can survive.
Right.
you can lose, but if others are out of the game through margin calls, in the end you are the winner. So initially that think. Secondly, think of a trader first as a money manager, and then as an analyst, and then as a forecaster. But essentially as a money manager. Obviously, you have to make assumptions. You have to jump into the future and make scenarios. And you will try to capitalize on them, and sometimes it will work, and sometimes it will not. That is something that we can't hinder. We must make scenarios in order to expose ourselves to in a certain direction. Otherwise, you can't have any return. But if I would put a strong emphasis on risk management or money management. And by money management, I'm not talking about simplistic rules like don't risk more than 2% of your account in each trade. I think that is not going to work. I mean, or even risk rewards. Think in terms of risk reward. I will risk 1 to make 3. Where in life do we risk less to obtain more? I mean, it's wishful thinking, obviously. I mean, there is always something involved to get something. So why do we think differently when trading? And it's a little bit humanizing, like you said, trading in the sense that understanding how our brain works, and in this direction, I think behavioral finance is offering a lot of interesting theories, and it's really serving in the recent years as the theoretical backbone of technical analysis, of what technical analysts have been doing for centuries. And I think we will see a lot of changes in this regard with the help of technology, with the help of new ways to approach the market. And probably technical analysis will be in 5 years' time will be totally different than it is from now, because we see models just tumbling apart. I mean,
all the time.
Yeah, all the time.
You know, it's very interesting, the change, not that the internet has wrought, because the internet basically gave everyone access to just specifically foreign exchange, a market which was purely a specialist market before that. No one knew much about foreign exchange. It's also brought along an enormous outpouring of education, of tools, of attendant things to do with getting people both involved and learning about it. I remember when I started trading about 1990 on a bank desk, and I'd ask, and I had no idea. I'd ask the other traders, and traders are generally an inarticulate lot. They don't really say much about what they're doing, or, you know, it's much more instinctual. And all they delivered up were cliches. And one of them, which I remember very well, was when you learn how to lose money, you'll know how to make money. It made no sense to me whatsoever. But in fact, it does. Because what it is the essence of money management, which is the hardest thing to learn. How do you approach actually teaching it? As you say, that you can make rigid rules, but rigid rules don't really work. Because the rule is designed with a purpose, and the purpose changes. So how do you approach money management to impart it to the people you're educating, the people you're talking to?
Yeah. Well, at one hand, I would go to the basics, very basics of currency dealing. You know, things like calculating what the value of a pip is, what is your margin, available margin, consumed margin, where is your average buy price, what is your exposure, your long exposure, your net exposure, your short exposure, net exposure, and things of that sort. And this is very are just formulas. You don't have to guess. I mean, it's very straightforward. Once you know this, that you can start constructing scenarios based on money, based on the money you have. You have a scenario, say, well, I will try to capitalize on 100 pip move upwards, and I want to risk 200 pip downwards, and with my current exposure, what is this worth, this movement worth? What in terms of risk and in terms of potential? So I would start on one hand with very basic mechanic stuff, and on the other hand, I think I lost a little bit my the path. Your question how I bring money management, right? Yeah,
because when most people take positions, traders, I mean, after all, the purpose of trading is to make money. It drives all of the markets. It's the reason why you mentioned the equities is the most hated rally in history. But is it still going up? Yes, because the fundamentals take backseat to any type, and sort of technicals, but more fundamentals, to any type of market trend. Because a market trend is the easiest way to make money. And so everybody will get on the back of that. And they should. That's exactly what your job is. But when you're telling individuals that they have to manage their money, that they have to be responsible and monitor what's going on in the market, and not to think that every trade has to be a profitable trade, how do you convey that to people, since their emotions tend to be involved in trading, certainly on when they're beginners?
Yeah. See, the techniques we are using at one hand, as I was explaining, are very basic in the essence. It can be reduced to a formula, but then there is also a conceptual switch in the sense that when you construct a position in a foreign exchange market, when you construct a long position, a short position, and you are trading your account, you have your balance and you have your equity. The equity is really what matters. Yeah, right. And you can enhance your equity by taking losses. This is something we do on our everyday life. I mean, if I have an old car which consumes a lot of fuel, which pays higher taxes because it's old, from time to time it has to go to do some repair. It is eating up my equity. Instead, if I transform that, if I sell that old car and I transform money from my wealth into a new car, yes, it's true. I lose some liquidity because I bought a new car, so it's like I have a new position. I have margin tied up to a position, but my equity stops going deteriorating. So I can make money by accepting losses, and this was the second part. I just lost the path, which you were mentioning. I can make money through accepting losses, but this is only possible if you think like a dealer, like a market maker, in the sense that you are constructing a position. The position can be made of short-term, very short-term, mid-term, and long-term scenarios, but you have all sorts of trades in that position. And you have both sides, the long side, the short side, and by managing that, by increasing exposure on one side or decreasing exposure on the other side, that is accepting losses eventually, you can make money. You can increase your equity, because in the end, it's the equity curve, what's worth, what your account is worth, is not the balance. So I try to convey these kinds of things, that even a drawdown, the concept of drawdown, in our trading approach, we live with a constant drawdown. And the drawdown, if you live with a floating drawdown, the drawdown is not something that you have to recover from. We all know the statistics of drawdown recovery. I mean, from 30% on, it becomes really difficult to recover a drawdown. A 50% drawdown requires 100% return on investment to be break even only. So, but what if you have a controlled 50% drawdown, but you have made a balanced growth of 200%? So still your equity has grown. So you can live with that. So this kind of different thinking in trading is what we try to convey with our trading.
Yeah, drawdown that's too large is a bit like a population decline. You know, at some point it becomes impossible, almost impossible to recover because there just aren't enough people. You know, you mentioned earlier treating FX as an asset class. Most portfolio managers do not do that. I'm talking about equity portfolio managers, people who deal in the larger markets. Do you think, one, it's possible to treat foreign exchange as an asset class as opposed to other assets such as bonds and equities and commodities and the other things that people take positions? But also, do you think it's possible to treat foreign exchange within foreign exchange as an opposing portfolio? So you can have one currency that under a particular analysis is more likely to go down and another go up, and oppose them, sort of as you would a long-short trading position or a long-short trading philosophy in equities?
I believe both are possible. It depends. I mean, it can serve both functions, investing in foreign exchange. On one hand, I would suggest for any global trader or any international investor to look at their assets or look at any market they are trying to trade, to look at them not only in absolute terms but in relative terms. Translate them to your homeland, to your I wanted to say language, to your home currency, to your domestic currency, and also translate it to other currencies to see if that eventual appreciation is really global, if it's not a thing of currency like we had in the FTSE with all the depreciation of the sterling in recent months. So first, look at the world in a multi-currency perspective. Then, obviously, you have the other part where you can build scenarios where a currency by itself or a particular currency by itself can become an investment. And I mean, here I have built my own vision of it. We have been told we are in a free floating market since the 70s, but I mean that is up to a certain point that is true. But if you look to currency charts, if you try to build currency indices based on different weighting formulas, then you really realize that it's not an equal market. It can't be an equal market where you have one currency serving as the global currency or the so-called reserve currency and all the others around it. By doing this little exercise of building currency indices, you see that even the euro against the dollar, it has been floating in a kind of managed band. I mean, it is not a really free-floating condition which would enable true technical analysis to be applied, because it requires really free-floating conditions. But we have the dollar against everything else, and unless we see this system renewed or redesigned, we have to have this very closely in mind if you want to build a portfolio where currency is an investment, where we look to invest in a particular currency. Never obviate the fact that we are in a system that was created not so much by design, but by political will at that time. We have to go back to Bretton Woods and so forth. And come up with a vision for the near future. I say near because I don't believe that this condition may be sustained more than a decade like that. We will see. But in any case, both. Yeah, you believe so?
We're not sure. I mean, one thing that's true, you know, if you had a theoretical market that had no outside inputs, and it was only the traders and their interest in profitability, then you would have almost a pure technical analysis market where it would be the internals and the positioning and the psychology was the only thing that mattered. But we don't, certainly, as you point out, don't have that at all. we have this very elaborate system that has evolved and not been planned, where there are a great deal of inputs that determine trends. I mean, if we look at the euro from 2014 on, you're talking primarily about the difference between the ECB policy and the Fed policy. Initially the ECB and then compounded by the Fed. How do you fold that into your technical analysis portfolio? How do you account for that when you're educating people?
Well, what I would suggest in this case is to do an exercise, and we are doing this in one of our editorial pages, is to organize arguments for both currencies, for both monetary policies, and for both economies, to categorize all the arguments you can find from all sort of sources, and organize them by what is considered bullish, what is considered bearish for one currency, for the other. You come up with 4 quadrants for each currency, a bearish and bullish arguments, where obviously monetary policy is part of it. And then do the weightings and the timings and establish a preference. At some point, you have to have a preference. I would suggest to do that, but I also would suggest to go a little bit beyond these narratives, because we can easily fall prey of the last story told, or the last theme, and by organizing the topics, it will help you to have in mind things that perhaps was the topic 3 weeks back or 3 months back, and no other talks about now, but it's still there in the underlying. It enables to put things into perspective, but besides this whole exercise, I would suggest to add another layer in the decision making, and this layer is something that basically we do not look for it, because when analyzing markets, we try to look for externals, for all sorts of external arguments. But in the end, when you interact with the market, you are part of your methodology, and you can be right, you can be spot on a scenario, but unable to make money. I can remember, Joseph, it was back in 2007 when we met here in Barcelona. We spent like 2 or 3 days in the conferences, and
I remember
we had this last evening, the party on the beach, and we were surrounding you, we were talking markets, and someone in the group asked, "Hey, Joseph, come on, give us a trade call. Give us a trade call." It was 2007, and right. I guess I can tell it now. You were working for a different and you told us, short the euro yen, short the euro yen, and don't tell anyone I told you this.
Did I turn out to be right?
It was, I mean, it was the biggest trade of our lives. Yeah, for the people who started in the early 2000s. I mean, we could have retired on that trade. I mean, and I remember people trading during those days, trying to capture the market in those days where the euro dollar moved 300 pips in one day, and not being able to catch one single pip, to lose money. And people were like, what is going on here? It was impossible to get in. And you need to build your scenarios and to be prepared and positioned for this kind of vertical markets.
That is
they happen from time to time. I mean, we had this the Swiss peg 2015 January, and we will probably have this kind of scenarios repeating again. But it doesn't have to be a flash crash format, but a market which, if you are not in the moment it starts, it's very difficult to get in unless you get in not leverage or infra leverage, and you do not make money. So
well, we had a market like that very recently. We had it 6 months ago with the election of the American president. Totally unexpected. The markets went very wild, but from a trading point of view, it was a fascinating evening. And I know, aside from the politics, which I'm going to leave out, of course, I tell people sometimes, in New York, which of course did not support Donald Trump, that it was a great night. And of course, they get horrified. What do you mean it was a great? It was horrible. I said, no, from a market point of view, it was a great night because it was a very volatile evening. It was very unexpected, and it was fascinating to watch and participate in it. One more question, because I know we're getting towards the end, we're running a little over. You spoke earlier about the changes that the euro has wrought. This is a question for me as an American asking a European. What do you think is the future? I mean, there have been a lot of political turmoil on a series of elections. There was, of course, the Dutch election and the French election, and prior to last year was there the British election, two of which have gone the way, the European elections have gone the way of the euro. They did not choose the candidates who were basically anti-euro. What do you think is going to happen for the next few years as the euro continues to evolve within the European monetary system?
Well, I'm not sure if I'm going to put
you on the spot for this, because I'm personally interested in this answer, and I ask everybody whom I come into contact with, because the view from Europe tends to be different than the view from the United States.
Yeah, the thing is, there is a danger to it, because obviously we had the results recently in France and previous in Holland as well, supporting the euro project. Right. The problem is if the tensions arise, and I can tell you, I travel quite a lot to France, to Germany, where we have relatives, especially in France. I mean, the air is so tense there, as I've never seen in the last 10 years or plus. Right. You can cut the air with a knife. It's impressive, the amount of aggressiveness in the people, in the media, really? In the conversations. I've never seen Germany. Right. Germany the same. So okay, you have the results supporting the project, but the underlying problems, they are there, and the risk here is that people totally lose confidence in the political project, and when you have that loss of confidence, then things can get very ugly, because to rebuild that confidence, that trust, will probably take a redesign of part of the system. And when related to trading, I mean, this will have its consequences. I believe that what we are seeing now in the euro is just hot money reacting to the latest themes. But we had last year, 2016, 15, 14, I believe, we had capital outflows from Europe, like we have never had in the last 14 years or 15 years or so. So this already tells something. We have a little bit of rebound now in the Q1 2017, but time will tell if this is a reversal or not, if we hit some bottom there. But I believe that smart money understands the issue and understands the danger, and moves to places where the danger is not acknowledged as critical. Here in Spain, I don't see the situation as critical, socially speaking, when obviously the conditions are very similar, or if not worse in some cases. But really, on the street, talking to people, France and Germany, there is something really cooking because it's not normal what you experience there.
Yeah, one of the things I'm going to be interested in. I mean, I'm taking my family to Italy, and this is a vacation, but I haven't been to Italy in about 8 years. And that's an 8-year period, which is a very big change since we're talking about the period post-financial crisis and everything that has transpired from that. And I'm interested to see how that has affected both my relatives, but also the country, and as you say, the feel of the social contract, if you will, between the people and their government and politics. From a trading point of view, it doesn't seem very possible for the Europeans to abandon the euro, just from a trading point of view. Because how do you get back to 25 different currencies from where they are now? Do you think there's any possibility of that? How much worse would it have to get before that becomes a realistic alternative?
Yeah, I don't think that we go back that way. I mean, we have right now technological advances that will probably provide an alternative to that, or we will come up with a different tier system where you have still the euro to transact internationally, but local currencies emerging. We have a boom in local currencies, not from now, but in the last 10 years. All over the world, local currency is something that, I mean, it passes unnoticed, but there is a search for alternatives,
Right.
and now that technology provides the venue to bring a kind of alternative to the system, to the standard system, then
there is Bitcoin, of course.
Yeah, I'm referring to
an idea.
Mm-hmm.
One last question on this, and then we'll end the interview because I know we've run over here, and I thank you for staying. The original idea of the euro was that that the countries that join the European Union are slated, as part of the agreement, to join the euro. So you have now many of the Eastern European countries that were part of the former Soviet bloc, Poland and Hungary and Romania, which do not seem to have any intention at the moment of joining the euro. They are fully happy with their convertible currencies that they control. Do you see that as any sort of threat to the euro?
I think so. I mean, it's the rate of change. We have this measure in technicals, the rate of change, the rate of newcomers to the euro has dropped to zero. No one has adopted the euro for years. So that already is an evidence that something has to change in its design. In the end, money is about confidence. I mean, you can take a note and it's a piece of paper which is worth, I mean, pennies, and the rest is trust, is confidence, and this is not something that you can manufacture, or even there are some words telling that perhaps the financial center will move from the city towards Germany, to Frankfurt. I mean, you cannot politically decide where a financial center will be that easy. Money has to go in first, and then around money you build a financial system, but not the other way around. And I mean, it becomes more and more difficult to impose the euro currency into other countries, and we'll see. But definitely, this is not a good sign if it hasn't been adopted. It will be also interesting to see in your trip to Italy how crowded the churches are these days.
I hadn't thought of that.
I guess everyone is praying for a better future. But,
there's a phrase in Italian that they talk about tourism and what you see, and it's un'altra chiesa. It just means, and when you're touring, and another church. There's always another church. Gonçalo, I thank you very much for spending this extra time with us, and I thank you for doing the interview with us. It's been very interesting, both on the technical side and on the fundamental and the European side, which I find personally, and I think for our market, for our listeners, is very compelling. I thank you very much for coming on, and I hope that maybe we can meet again. It's been almost 10 years. That's too long.
That's true, 10 years.
But we'll have to talk to FXStreet and have them do another event. I had a great time in Barcelona when I was there. All right, thank you very much, and you have a great day there. And again, thank you for coming on.
Thank you for having me, Joseph. See you soon.
Take care.
Bye.